Check Podcasts.
Hi, I'm Bruce Williams. I'm the CEO of the Greater Victoria Chamber of Commerce. This is Chamber Chats, coming to you as always from the podcasting studios here at the Czech Media Group, one of our chamber champions. I would like to acknowledge, as always, that I live and work in the ancestral territory of the Lekwungen-speaking people, known to us as Songhees and Esquimalt nations. In fact, our guests today are joining me here in Lekwungen territory. Chamber Chats is made possible by the support of Island Savings, a division of First West Credit Union, who have a team of individuals and professionals with solutions as unique as your business. So, we're going to talk about business. We're going to talk about money. There is no one among us right now who has not been impacted directly or indirectly by the current inflation and the interest rates. So we all know people that we consider to be good with money. Are you good with money? You should go talk to her. She's really good with money. On the other hand, there's other people that are horrible with money. They don't know what they're doing. They can't manage debt. They can't understand it. And a lot of us fall kind of in between and in the middle right there. All of this comes down to a term called financial literacy. So in other words, how literate are you with your finances and how well do you manage them? We're going to talk about that today with a couple of professionals. Luke Biles is with us. First of all, he is a partner in private enterprise at MNP, also one of our chamber champions. Luke, welcome. Nice to see you.
Hey, it's great to see you, Bruce. Thank you for having me.
And Travis Koivula is a senior wealth advisor with Island Savings, our folks that help us get this on the air every week. Travis, how are you?
Great. Thanks for having me here.
Travis, I'm going to start with you. What is the best way for someone to sort of take a look at their situation and how they manage their money to assess their level of financial literacy?
And that's actually a tough question because there is no scale for literacy. It's not like luminaires or how bright something is or how loud something is. You can't really figure that out. But what you can do is get a little better every day or every week and every month. And I really encourage folks to, wherever you are, is to learn. And the best way I know how to learn is to read. And I've got some great books that I would challenge anyone listening to this to read. And the first is Morgan Housel's The Psychology of Money. Great book, timeless principles. There's another one called Just Keep Buying by Nick Magalui, and another great book. And then I'm not sure, Bruce, have you read Atomic Habits by James Clear?
I have not.
And that is a great one about setting habits, whether they be financial, fitness, whatever, and making stuff easy that you want to do and hard that you don't want to do.
Yeah.
Luke, how about yourself?
You know what? I did a quick Google of this yesterday because I felt the same way you did. Where how do we figure this out? In a lot of cases, we don't know what we don't know. It actually turns out that the government of Canada has a quiz. And you can do that quiz and get a financial literacy report card that gives you kind of a rating on various areas. So I did it yesterday. I now know which areas I need to improve on, and I'm going to work on that going forward.
So Luke, you do your stuff largely with businesses, as Travis is with personal finances. So Luke, when a business gets into trouble financially, you and the professionals at MNP can help them sort of better manage that, right? Tell me how that works.
Well, it all boils down to understanding your position. And a lot of people, especially those who are not necessarily on the higher end of financial literacy, their preferences might be to ignore it. And so getting a professional involved, be it on the private enterprise side of things, or if things are really bad, talking to somebody in debt consolidation or bankruptcy might be the way to go. But essentially, understanding where you are is almost always step one to any process.
So money management and spending and borrowing and all that sort of thing can very often be determined by habits that people have, lifestyle, whatever it might be. Some are good, some are bad. Travis, let's talk about the bad. What are some bad habits and how can they be corrected?
Well, they say it takes 30 days to start a good habit. I can start a bad habit like day one. Like I don't need 30 days to start a bad habit. It goes right away. And I think the first thing is you got to know that you have a bad habit, right? Like how do you know that to correct something unless you don't know what it is? So acknowledging the fact that you do have a bad habit. And then if you can replace that bad habit with a good habit. So maybe it's you're eating out too much. Well, at lunchtime. Well, then you make your lunch every day. So that's a good habit. You're making your lunch every day. Or maybe you're spending too much just on entertainment. So you are going to start to look for free things to do. And so I would be looking at, okay, acknowledging bad habit and then finding a good habit to replace that bad habit. And that'll, and you can, you ever thought to yourself, don't have ice cream. Like, I'm not going to have ice cream tonight. What are you going to like? I guarantee you're going to have ice cream if you say don't have ice cream. So saying don't do something, it's telling your brain doesn't hear the don't. They just say, go have ice cream. So I wouldn't say that, but I'd be proactive in your habits. Like, I am going to make my own lunch. I am going to buy my groceries at the grocery store. I'm going to walk to work. Whatever it is, it's going to be a positive thing, not a negative thing. Because the negative thing, I think our brains just focus on that, and we end up doing what we don't want to do.
Yeah, Luke, there's a lot of people that are kind of afraid of dealing with their finances or taking a look at it. I don't know whether it's because they feel that they're not really tuned into what's going on. They're afraid they're going to feel stupid or something. But what do you hear about that, and what can people do to be more better informed?
I totally agree with you, and it depends on the person. But some people, they take things like that very personally, and they all, like all of us, we always want to present our best selves, right? If you look at social media, it's a collection of the best moments of our lives and things like that. And nowadays, when people kind of have to look at these areas that might be difficult for them, or areas where they're not doing so well in, they can kind of ball up and put their head in the sand, like the old tale of the ostrich. It's really important though to be able to get out of that habit and to approach these things head on, because otherwise it's not, nothing's going to improve, nothing's going to change unless you're able to address the situation that you find yourself in. I think for me, some of the things that I talk to my clients about are like setting clear goals, and like Travis said, setting positive goals. They don't use negative terminology. Instead of being I won't do this, it's I will do this. And some other things that I like to do are bring other people into that conversation and that habit forming thing, right? If you have a spouse or a loved one or just people in your let's bring them into it so that you're accountable to more people than just yourself. And then when you succeed, celebrate it. It's like if you think about somebody quitting smoking, right? Like you got to celebrate that first week, that first month, that first year, all of those things. And that makes developing, I think, the new habit a lot easier. And then maybe lastly is tracking it, right? You're not going to know your progress unless you're paying attention to it. So if you can find a way to track these new habits, like I'm only going to go out to eat once a week for lunch and things like that, then uh, you'll be able to see your progress and be able to celebrate those things as well.
So one key to financial literacy and certainly better financial planning for everybody is, get ready for it, create a budget. So there are people that, again, are terrified of that idea. We're going to talk about budgeting next. On Chamber Chats today, we're talking about your level of financial literacy. Are you good with money or bad with money? There's a lot of things we can talk about concerning that. A couple of guys with us to talk about it. Travis Koivula is a senior wealth advisor with Island Savings, and Luke Biles is a partner in private enterprise at MNP. Okay, Travis, how do you go about creating a budget for yourself or your family or your business?
Sure. Yeah, absolutely. And I will admit, this isn't a fun exercise. Nobody likes looking at the sins of their spending, and that's what you're doing. And so just acknowledge the fact that, hey, this is going to be a little bit painful. I'm not going to necessarily, it's not going to be the most fun activity, is step one. And then step two is know what's coming in. So I ask many folks, and they maybe know on an annual basis what they get before taxes. They don't know after taxes. And so know what's coming in every month, and this can be kind of tricky because I've noticed now the shift for couples, especially if you're a couple, is to have individual accounts versus a joint account where all the money goes into. And I've noticed when folks do that, spending tends to be higher. It's just human nature. There's no sober second look. And so that can be a little bit tricky because you're now seeing what your spouse maybe is been spending or your partner's been spending. And so you got to know, what's coming in, and then I just mentioned it, know what's going out, and know what's going out. Like there's some stuff like painting your house only happens every 20 years. There's house maintenance. There's some stuff where people say, "Oh, this I'm only spending this," but really there's some big hits that happen either annually, semi-annually, quarterly, whatever it is. They happen throughout multiple years, so you got to account for those as well. And that's where often people get into trouble. They're doing well month to month, and then the dishwasher breaks or the car breaks down. And so they haven't had that extra buffer in their finances to account for that. And so having that in your budget is super important.
Yeah, that contingency idea. So, Luke, at the same time, a lot of people, as we mentioned at the top, are dealing with inflation. They're dealing with higher prices. They're spending more money. They're having a reduced capacity to save. How does that factor into creating a budget?
Well, it kind of goes back to what Travis said, where you're going to have these surprise things. So your budget needs to have wiggle room built into it for those surprise things. And I think the scale at which interest rates increased over the past year or so, probably, well, it surprised me. I'll say that. And so, making sure that not only do you have wiggle room for saving, but wiggle room for those larger changes that might happen. The price of gas is another highly volatile expense that most of us incur on a weekly basis. That is also changes significantly from one moment to the other. And groceries, milk, things like that. So it's important to have that wiggle room built in, and especially understand um, what parts of your expenses do you have control over? So you don't have control over your rent or your mortgage, your insurance, things like that. But you do over your restaurants, maybe even over your groceries, the types of food you're buying. Organic is more expensive than non-organic, things like that. So if you can understand which types of behaviors and habits you have control over and you can change to adapt to your new financial position, you're going to be a lot better off.
Yeah, and Travis, when we were getting ready to record this, you mentioned the idea about grocery shopping, as Luke just mentioned, but doing it once a week instead of every day or more often can save you money, right?
Yeah, absolutely. Well, because when you go to the grocery store every day, you don't just get what you need, right? Who gets what they need? You get what you want. You get extra stuff on there, and then I've got a challenge for everyone listening, and it's called Fridge Zero. And this isn't mine. This is somebody that I found online. And is to eat all the food in your fridge before you buy new food, and that's going to force you. And it kills me, Luke. It kills me to throw out food out of my fridge because it's gone bad. It actually pains me. So if you do Operation Fridge Zero, you're less likely to have that pain.
And there's a challenge right there from Travis Koivula. Luke, you mentioned the idea of what you want and what you need. How does that whole thing factor into budgeting?
It's a really difficult one, and I'm actually a big proponent of including wants. I think we've all heard the idea of avocado toast pushing the younger generations outside of home ownership, but if you add up that $5 or $10 a day, it's not really going to move the needle too much in terms of that short-term goal of home ownership in a couple of years. If you extrapolate that out over retirement savings, then yes, $5 to $10 a day will make a big difference long term. But I think it's finding that appropriate balance for you and your situation. And so much of this is situation dependent. But that appropriate balance between quality of life and fiscal responsibility.
And then you have to.
I
Oh, sorry, Travis. Go ahead.
I was going to ask, how do people qualify wants and needs now? And what is a want, what is a need? And I've noticed that in our culture that a lot of want and the needs have become, they've gone back. And if you look back, like most people will kind of say like the 1950s were a great period of time for everyone. Like, and the reason why it was because there was a shorter gap between people who are doing really well and not doing really well. And so I think if we see other people doing really well, we want their stuff, and then it kind of brings up spending. So yeah, so that was my thought.
For me, some really easy ones are vehicles and phones,
Yeah.
because you can use a phone with a crack down the screen for years, and that is the difference between a want and a need. And similarly on vehicles, do you really need that new car, or can you get by, especially out here on the West Coast? I'm an East Coaster. When I talk about buying a used vehicle back home, people laugh in my face. But out here, you can get by with an older vehicle really well.
Well, I
Absolutely.
drive a 12-year-old car because it's working just fine, and I love it. So,
Perfect. Yeah.
okay. So another word that will strike terror into a lot of people is debt. Debt is a part of your financial literacy model as well. We're going to talk about that next. We're talking about your money today on Chamber Chats with a couple of guys who are giving us a little bit more insight into the idea of all of us developing more financial literacy. Luke Biles is a partner in private enterprise with MNP, one of our Chamber champions, and Travis Koivula is a senior wealth manager with Island Savings. Okay, Travis, what are the best options for borrowing? If people are going to decide, yeah, I'm going to bite the bullet and borrow money, what's the best way to find your best option to source that money?
Great. Yeah. So I'd ask the question first before you borrow, what are you borrowing for? Is it an appreciating asset? Is it depreciating asset? Why are you needing money all of a sudden? And examining that. And is it because you've been paying too much, your lifestyle's been more than your income, and you're going to have to, refinance or borrow to pay off past purchases? Then having an intervention or a moment of, okay, like we are going to do this borrowing, but we got to correct some stuff in our life before we go forward. Or is it, hey, you know what, great, we're going to buy a house, we're going to buy a condo. And so finding out why you're borrowing is really important. And then seeing the product that's going to be best for you. So I think the common misconception is the best rate is going to be the best product for me. Like if I get the lowest rate, that's going to be the best, borrowing solution. And it might not be the case. There's different ways that rates are calculated. Are you going to be paying off the mortgage early? Do you need certain features with it? And so finding the right product for why you're borrowing is just as important as rate.
And on a business side of this too, Luke, people, they will have a credit union or a bank that they deal with all the time. The assumption might always be, I'll just go to the usual source. What are the options for not going to the usual source?
And it's super important and super valuable. And all my banking friends are maybe going to wag their finger at me right now, but I think there are a lot, especially for businesses. There's a lot more options in terms of financing, whatever it is that you're looking to finance, be it property, be it equipment, or just be it operations. And talking to certain brokers, we all know about mortgage brokers when it comes to houses, but there are business debt credit brokers as well here in town, across Canada, things like that. They're able to work with you and then work with all of the banks to find the product that's going to be right for you. And what I see practically is that ends up working out pretty much the best. If that's not an option for what you're particularly looking for, like many things, you kind of want to get a second and even a third opinion. So don't just go to your bank, go to the bank down the street, go to the next bank, or options like that.
Okay, so you get the loan, you got to start paying it off. We're going to talk about credit card debt in just a minute, but Travis, let's talk about that. When you set out to pay off debt, you should do it as quickly as possible, right?
Absolutely. And I've seen two approaches that work. And first one's called the snowball effect, where you choose the debt that has the lowest balance and you put all your resources to paying off that one and making minimum payments on the other debts. And then once that one's paid off, you go to the next lowest and it kind of snowballs to pay off debt, and it builds momentum for you because you feel good, you're getting rid of your debts. So that's one approach. The other approach is to attack the highest interest rate. So whatever one you're paying the most on, attack that one first because you're getting your biggest bang for your buck. Both work. Whatever is great for your circumstance is going to be the one, and the one that you can stick to. So, it's all great in theory, but if you're not able to stick to the plan, it's all for naught.
Yeah. So Luke, the highest debt, of course, is credit card, or probably a line of credit because they are sort of way up above prime. Uh, that's the priority, is taking a look at credit cards and loans of credit first, I would think, right?
Yeah, it depends though. Those for sure are kind of up in the 20% interest zone. I find. So you typically do want to get rid of those because that's a high cost. When it comes to like equipment debt that might be at 7 or 8% or things like that, then we have to think about what else our money can be doing for us. So could I instead take that cash and reinvest it into my business and earn a greater return on it than say the repayment of that debt would get me?
Okay. I want to loop back now to the question about where do you go to source the money from that. Travis, really basic question. What's the difference between a credit union and a bank?
Yeah, absolutely. So credit union is part of the cooperative movement. So we see cooperative grocery stores, gas stores, and it's member owned. So we're owned by people who deal here, and it's great. And we all pour our profits back into the communities. And one of the great things that I've seen over the years in downturns, credit unions often have a lower rate of default on the mortgages that they have and debt that they have because they know people really well. And so they have a great relationship. And so one of the things is when you're shopping for debt or any product, just having a great relationship with your lender is really important because credit unions are often able to be more flexible than other institutions because we know people so well. We're part of the community, and we really just want to see the community grow and thrive.
Yeah. There's a certain time of year, Luke, when people say to themselves, should I borrow money to top up my RRSP? In other words, should you borrow to invest? What's the book on that?
A really interesting one. And I'll say this for every question, it's quite specific to the person and their situation. I know people that have to go that route because it's the only route that they will end up putting money in their RRSP. If they have a debt, they're really focused on repaying it. But if they have cash, they're not necessarily focused on saving it. So for some people, it works out well that way. For a lot of other people, though, you have to think about what's actually happening there. You're paying interest on that credit. So the returns that you get on your investments are subtracted by that amount. So you will be earning less overall if that's the case for you.
Yeah. Travis, is it ever too late in life to examine your financial literacy?
Great. Yeah. So I was talking with somebody from my kid's school, and she was really excited that she was working with her grandfather. And her grandfather, a few years earlier, he's actually a well-known person in Victoria, had liquidated a bunch of property, and he's kind of bored. And he's in his late 80s, and so now he was starting to do development with his granddaughter. So I don't think it's ever too late. I think it's always you always want to be learning, and you always want to be helping grow your knowledge.
And there's something in the financial world or the budgeting world called the 50-30-20 rule. Luke, what's that?
I had to Google this one as well, but it makes a lot of sense, right? And
Yeah.
it's great to have these rules of thumbs and guidelines to just help get you there. That's kind of a breakdown of your needs, wants, and what you're sticking away for later. So 50% of your budget or your income could be allocated to needs, 30% to wants, and 20% we should be sticking away for a future day.
Just for
You know,
savings.
I'll
Yeah.
piggyback on that one, and I like the 10-10-80 rule, and that's give 10, save 10, spend 80. And I found that when people are generous, so they're giving to charity to people who are less fortunate, you kind of examine stuff in your own life, and it becomes less important because you're making sacrifices in your own life to help somebody else. So that's one that I also really think works.
So if you at home are taking a look at your own financial literacy, and this has maybe spurred you into that conversation, do speak to your credit union, your bank, business professionals like MNP are always there to help. And gentlemen, we appreciate your time today. Luke Biles is a partner in private enterprise with MNP, and Travis Koivula is a senior wealth manager with Island Savings. Gentlemen, thank you both.
Thank
Thank you.
you very much.
I'm Bruce Williams, and I'll see you again for another Chamber Chat.